Good afternoon. This week, a Chinese lab did something Washington never managed. It made the most crowded trade of the last 2 years look expensive. Moonshot's new model, Kimi K3, an open model anyone can run cheaply, scored at or near the very frontier. And the market treated it like a second DeepSeek moment. Roughly $3.3 trillion has now been wiped off global chip stocks since late June. And the main semiconductor index has fallen into an outright bear market. Almost everyone said the same 3 words. The bubble popped, but look underneath, because the tape is telling you something more interesting than that. Let's get into it. Here's the board. Stocks fell on the chip rout. The S&P closed down about 1%, near 7,458. The Nasdaq down 1.5% as semiconductors led. The Dow cushioned by a rotation into defensive names. The story sits in the middle 2 tiles. The chip index is now in a bear market, more than 20% below its June record, with roughly $3.3 trillion in value gone since late June. And on the same tape, Apple retook the title of most valuable company from Nvidia, near $4.9 trillion. Now the cross-currents. The 10-year Treasury yield backed up toward 4.6%, but on oil, not growth, after fresh United States strikes on Iran and a near shutdown of Strait of Hormuz tanker traffic pushed crude up about 4%. And here's the tell inside the tell. Gold is sitting near its all-time high. Yet it slipped on the week, even with a live war headline. That only makes sense if the market is reading this oil move as inflationary, a firmer dollar and higher rates, not as a reason to run for safety. Bitcoin is quiet near 63,000, pinned on its 200-week line. Hold that gold detail. It comes back. Now the signature segment. Consensus versus the read. First, and this is today's deep dive. The crowd's instant verdict on Kimi K3 was simple. A cheap Chinese model means artificial intelligence spending is a bubble, so sell the whole build-out. But think about who actually loses when intelligence gets cheap. Cheaper artificial intelligence is the biggest input cost cut the software industry has ever been handed. It is deflationary for the company selling the shovels. Nvidia and the chip complex, because you suddenly need less expensive compute to get to the frontier. But it is a gift to everyone who buys intelligence to turn it into a product. So $3.3 trillion left chip stocks, but the value it represented did not vanish. It started hunting the other half of the trade. The crowd is dumping the gold rush because the shovel got cheaper. High conviction, and Frankie takes the whole thing apart in today's focus. Second read, turn on any market channel and you get 2 confident, opposite answers. One camp, healthy reset by the dip. The other camp, the crash has finally started. And here's the asymmetry. It is genuinely rare to see this wide a disagreement among credible, experienced voices at the same moment. That dispersion is itself the signal. When the smartest people in the room are this far apart, the honest read is not a direction, it is a wider range. Position for elevated volatility, not for a side. The tell is not who is right. It is that nobody agrees, and that alone tends to mean bigger swings ahead. Medium-high conviction. Third read, the other scary headline this week was SpaceX, freshly public and already more than 40% below its peak, trading under its offering price, with its Starship test flight scrubbed on the pad Friday. And the crowd wove it into one story. The whole speculative Moonshot trade is dead, but be careful. SpaceX is a sentiment barometer, yes, but its break is idiosyncratic. A launch failure plus a stretched first-week valuation. Not a verdict on artificial intelligence demand. Don't let a rocket that couldn't clear the pad tell you what a chip cycle is worth. Medium conviction. Follow the money. The regime question this week is not, is artificial intelligence real? Kimi K3 answered the opposite of a bubble. Artificial intelligence just got cheaper and more accessible, which is bullish for adoption. The real question the market is voting on is, who captures the value now that the intelligence itself is commoditizing? And you can see the vote in the flows. Out of the capital spending heavy infrastructure complex, the semiconductor index into a bear market. More than 20% off its June record after a 100% run, with Marvell, ARM and Intel each down more than 30% in the drawdown, and Nvidia dethroned as the most valuable company in the world. And into capital return, low spending names. Apple, up about 22% this year, retaking number 1 by returning cash instead of pouring it into a build-out, and the defensive staples, Coca-Cola, Pepsi, and Procter & Gamble, catching a bid that Jim Cramer publicly likened to April 2000. One more macro thread, because it's what's actually moving rates. The geopolitical tape got hotter. Fresh United States strikes on Iran and a near shutdown of Strait of Hormuz tanker traffic bid both crude benchmarks up about 4% to one-month highs. That is the reason the 10-year yield is near a two-month high, and it is the reason we keep flagging gold. On a genuine war headline, the classic safe haven pulled back on the week. The market is treating this as an inflation impulse, more reason for the Federal Reserve to stay patient, some voices even floating a hike, not as a flight to safety. So the swing variable for the whole disinflation trade right now is not a data release. It is the Strait of Hormuz. Contested but flowing is priced. A real closure is not. Watch Brent above 86 as the line where the inflation trade has to be repriced in earnest. A word on sentiment and positioning, because it's the mirror image of the data. Our market and social sentiment monitoring shows the commentary crowded almost entirely onto one story this week. Cheap Chinese model, the bubble popped, rotate to safety, it's April 2000 again. What that consensus skipped is telling. Almost none of it sat with the fact that Taiwan Semiconductor, the company at the dead center of artificial intelligence, just posted a record quarter and raised its guidance and got sold anyway. Almost none of it noticed that the big technology names people are calling the bubble have actually lagged all year. When positioning is this one-sided and the details cut the other way, the details usually win eventually. Here's the tell, the single most revealing data point of the day. Apple, which spends the least on artificial intelligence of any megacap, just became worth more than Nvidia, the company the entire build-out physically runs through. Apple is up about 22% this year. Nvidia is up just 7%. Pair that with a Chinese model that matches the frontier at a fraction of the cost, and both facts point the same way. The market is repricing the profit pool of artificial intelligence away from expensive compute and toward cheap, monetizable intelligence. That flip, not the Iran headline flashing over it, is the most important thing that happened this week. Sectors in play, 3 of them. First, semiconductors, and this is a repricing, not a demand crash. Taiwan Semiconductor posted a record quarter, up 77% in operating profit and raised its guidance, and it still fell about 7%. The market did not sell demand. It sold the bill, the capital spending, and the new threat of a cheaper Chinese rival. The split matters. The scale leaders, Taiwan Semiconductor and Nvidia, can absorb higher spending and outrun a cheaper competitor. The commodity memory tier, Micron and SK Hynix, cannot. Second, consumer staples, the defensive bid. Coca-Cola, Pepsi, and Procter & Gamble catching rotation flow. The bull case is real earnings durability. The bear case is that if this really is April 2000, staples are a symptom of the unwind, not a harbor. Third, crypto rails, price dead but structurally alive. Bitcoin range-bound over a month, but tokenization and institutional plumbing keep advancing, regardless of whether the Clarity Act clears the Senate before the August recess. On the radar, 5 things worth your attention. First and biggest, next week's big technology second quarter earnings. Microsoft, Alphabet, Meta, and Amazon. This is the monetization versus spending verdict. Do the artificial intelligence monetizers convert cheap intelligence into profit? That single question decides whether this rotation extends or reverses. Second, on July 27th, Kimi K3's full open weights release, when the market gets to test whether the benchmark claims are real. Third, Monday evening, the Starship reattempt after Thursday's scrub, and how the newly public SpaceX stock trades below its offering price. Fourth, the Clarity Act, which needs about 7 Democrats and has none aboard, against an August 10th recess deadline. And fifth, oil and the 10-year, where the Gulf escalation is the swing factor for rates and for the disinflation story. The scorecard, where we grade the dated calls, including the ones that go against us. 3 new calls go on the record today. 1. Kimi K3 is a value migration event, not an artificial intelligence demand top. Over the next month, the application and monetizer names hold up better on a relative basis than the pure compute and chip complex. That's falsified if the monetizers miss or guide down on monetization next week and lead the whole complex to sustained lower lows. 2. At least 2 of the 4 big monetizers beat next week, and the story that artificial intelligence spending never converts to profit gets challenged, not confirmed. 3. Gold holds its record zone, near $4,000, as an inflation hedge into the oil shock. Falsified if gold breaks decisively below 3,800 while crude stays bid. And note, we are deliberately not putting a percentage on gold. Now the carry forwards. Yesterday's call that the Apple over Nvidia crossover is a rotation, not a demand verdict, is tracking. The crown held. And our call that Brent doesn't sustainably hold above $80 is under pressure at 86. The close, the most expensive habit in markets is mistaking a price move for the news that caused it. This week, the news was loud. A cheap Chinese model, a $3 trillion chip rout, an oil shock, a crown changing hands, and the crowd wrote the obvious headline, "Artificial intelligence is over." But the company at the very center of it just posted record earnings, and the market sold it anyway. That is not a verdict on the technology. It is the market repricing who gets paid, now that the intelligence itself is getting cheap. So here's the one to sit with. When intelligence gets cheap, the shovel seller loses, and everyone who uses intelligence wins. So is this the gold rush ending, or just the market finally noticing the shovel got cheaper? Today's focus goes deep on exactly that. The asymmetric signal. One contrarian read a day. Subscribe.